Hello, and welcome to today's presentation on sales and use tax issues that aircraft owners must know. I'm David Brennan. I am a state and local tax attorney, and one of the areas I focus in is on sales and use tax issues as it relates to aircraft. Now, what we're seeing here are a ton of audits from the Florida Department of Revenue relating to aircraft. And so this presentation is going to discuss today about the trips and traps that the Department of Revenue loves seeing aircraft owners commit, as well as their CPAs or attorneys too. So let me know if you have any questions. My contact information is on the screen right now. It'll be on the screen at the end of today's presentation as well. And also, for those that are attending that are either CPAs or attorneys, within a couple of weeks of the end of this presentation, you should be emailed a certificate with the course number so you can claim your continuing education. By way of background, I used to work for the Florida Department of Revenue as an attorney. And in my role there, one of the areas that I focused on related to sales and use tax issues as it concerned aircraft. Transitioning from government to private practice, I focus on multi-state sales and use tax issues, and I do also work heavily on aircraft issues. I used to be an accountant, so I have my accounting and finance degree. Of course, I have my law degree, and I have an LLM in taxation. Now, what we're going to begin today's presentation with is just some general statements. And then we'll expand from there on a lot more of the nuances here. But state sales and use tax is generally going to be imposed on certain transactions, certain tangible transactions, as well as certain enumerated services. When there's a state tax that's imposed, a local or county tax should be imposed as well, assuming that the county has a tax to impose in the first place. There's only a handful of counties in Florida that do not. But with that in mind, that type of imposition of tax captures a myriad of transactions. And as we'll see later on here, we'll see that this captures aircraft as well, because aircraft in general are tangible. And it not only captures the actual acquisition of aircraft, but also if the acquisition occurs outside of Florida, it can capture the use or storage in Florida. It can also tax the lease of aircraft as well. But in order to do that, the Florida Department of Revenue has to initiate an audit. And there's several different ways that an audit can be started. One is a letter audit. Now, a letter audit is usually about a very specific transaction. And as the case as it applies to aircraft, that's a lot of what we see here are a specific transactional audit. Now, the state of Florida says, hey, we're auditing you for a specific aircraft N1234 and tell us about all the other aircraft that you have. Our position is you've listed in your audit notice that there's just one aircraft or however many aircraft there are that are specifically identified in that audit notice. And so what happens is we say, no, we don't have to disclose about other aircraft. If you wanted to do that, you could do a different type of broader scope audit, not a limited audit. But the department's position is that no, once they send that audit notice, they can audit for anything and everything at that point in time. The next type of audit is a self-assessment. Basically, you've got to throw yourself under the bus and figure out, hey, how much do I disclose? Is it too much? Is it too little? Where's that sweet spot on things? Which if you don't disclose enough, it could turn into the third type of audit, which is your full audit, your office audit. That's what you think of when you get an audit notification from the Florida Department of Revenue of them wanting to conduct a complete A to Z audit. They want anything and everything from general ledgers to invoices to vendor receipts, you name it, things of that nature the Department of Revenue is going to want to see, including federal tax returns, bank statements. The list just goes on and on. And unfortunately, they then use whatever the highest amount shows to tax individuals, rightfully or wrongfully. Finally, criminal investigation. I have not seen this in the realm of aircraft audits, but I have seen enough in other aspects where the individual really does need a lawyer at that point because they've received an investigative notice from a criminal investigator or a financial investigator who says, hey, I want to audit, or excuse me, I want to conduct a criminal investigation. You need to provide these records. So those are going to be the four types of audits. Primarily what we're going to be focusing on in today's discussion are the letter audits about the specific transaction. So let's talk about what is taxable as it relates to aircraft. And generally, broadly speaking, it can apply usually to other types of transactions for Florida sales and use tax purposes. So the sale or purchase or acquisition of an aircraft is subject to sales tax. The sale occurs in Florida, it's going to be taxable unless, of course, some exemption or exception to that rule applies. Now, if the aircraft is acquired outside of Florida, let's say in Georgia, well, Florida sales tax shouldn't be owed. But when that aircraft is brought into Florida and is used or stored in Florida, then tax can be owed. Now, there's certain exemptions that prevent an aircraft from being taxed as soon as it touches down, but those exemptions usually only apply to instances where the owner of the aircraft is not a resident. And then we'll get into discussions about what constitutes a resident and what about an entity versus an individual. Next up is leases. Leases of an aircraft in Florida are subject to sales tax. What I'm seeing the Florida Department of Revenue say, though, broadly speaking, and there's some variations here, but if the aircraft takes off from or lands in Florida, then all of the revenue in that period, that invoicing period, is subject to Florida sales tax. I disagree with them on that. I think broadly speaking, Florida is and has overstepped its legal authority to impose tax on leases with that aspect, because one should be able to apportion or prorate the amount of tax that's owed based on various conditions. We may get into that a little bit more detail later, but just know that it is an issue, and it's one that you and your clients can 100% fight back on, because it's my belief that the Florida Department of Revenue is completely wrong on this issue. Then finally, we have conversions from inventory. So the general rule is if I acquire an aircraft for resale purposes, but then I decide, hey, I am terrible at selling this aircraft or leasing it out, and I want to use it for my own purposes, maybe in my Part 135 operations. If that's the case, then the general rule is tax is owed on the entirety of the acquisition at the moment of conversion. But with aircraft, the unique rule is you can either pay tax on the entire acquisition, so a use tax, or you can pay tax, so your 6% rate, on 1% of the aircraft's value for every month in which this dual usage occurs. I call it the 6% of 1% rule, but we'll get more into that later on it. Just know that it's coming up here. Aircraft purchases are generally going to be subject to tax, as I noted a moment ago when discussing purchases, sales, and leases. Now, there are going to be certain exceptions or exemptions from that. And the exceptions or exemptions are numerous, too numerous to go through during an entire conversation. But some of those exceptions or exemptions can be, number one, the resale exemption, excuse me. Sale for resale, just like with the normal sale of tangible personal property, if I buy this aircraft because I'm going to resell it or lease it, then I should be able to acquire the aircraft exempt from Florida sales or use tax, because I'm going to be charging, arguably, sales tax to my customer upon disposition. Another exemption is going to be sales in Florida to a non-resident. So it's the flyaway exemption. The flyaway exemption is going to give that purchaser, a non-resident, the ability to acquire the aircraft if they meet certain criteria. One of those criteria is they have to submit paperwork to the Department of Revenue about the proof of the aircraft being registered and or removed from the state within a certain amount of time. And it varies. But with that in mind, there's also obligations on the seller as well. So it's obligations on the purchaser and obligations on the seller. The seller has to turn in certain paperwork, such as a sales invoice, a copy, if not the original, of the flyaway affidavit, among other documents, to the Florida Department of Revenue within a certain amount of time of the sales transaction. Now, this turning in of the documents to the Department of Revenue does not absolve the seller from keeping these documents to prove in his or her records that this transaction was exempt, because a lot of times what happens, the Department of Revenue does not have any type of tracking to document that they've received the affidavit or the other documents from either party, the purchaser or the seller, within the required time frame. And so arguments that say, well, hey, I sent this to you years ago and now you're auditing this and I don't have it, that's not right. That's not going to fly with the Department of Revenue on this. And of course, there's many other exemptions, such as sales to tax exempt entities, think churches, schools, other types of not-for-profits that have a Florida Consumer Certificate of Exemption. With the Florida Consumer Certificate of Exemption, though, the seller has to not only get that exemption certificate, but different from other exemptions, the seller has to be able to prove that the exempt entity paid with its own funds. And so there are a good number of transactions here, of ways to be able to exempt this type of a transaction. Let's talk about sales of an aircraft that occurred outside of Florida, but the aircraft was later brought into Florida by the owner or some other party for that matter, for whatever the purpose may be. If the aircraft was purchased in another state, then the first question is, was tax paid in that other state? If so, well, then Florida should give a credit for the tax, the sales or use tax, or a like tax paid to the other state. I'm not talking about ad valorem or property taxes, but something similar that's based off of the sales price of the aircraft. So Florida will give a credit for that up to the amount of tax that's paid to the other state, and Florida will not give any type of refund for tax, more tax that's paid to another state than what is owed to Florida. That's up to the aircraft owner to pursue that with the other state as appropriate. But if the aircraft owner did not pay tax to another state, then we get to the next bullet point of, is there an exemption that's at play here that exempts as to why the aircraft was purchased without paying tax? Maybe it was, maybe it wasn't. Maybe it was a misunderstanding of an exemption. Maybe they thought they did the exemption, but they really didn't do it. And the reason why this part is important is you might be thinking, well, David, we're talking about Florida sales tax. Why do we care about Arkansas or Oklahoma? And the reason is this: if the aircraft's acquired in Arkansas or Oklahoma or any other state before it's brought to Florida and tax wasn't paid to that other state, if there is no exemption that applies in that other state, well, then your client's going to owe tax to that other state first. That other state has the right, they have a higher pecking order than Florida to collect tax on the transaction. And so the client then needs to figure out, all right, what do they want to do? Do they want to pay tax to the other state and fight Florida? Or do they just want to pay Florida? What? The risk is this: if they did not pay tax that they owe to that other state, and Florida comes in and assesses them, and then your client pays tax to Florida, it is possible that other state where the aircraft was originally purchased in could later come in and say tax is owed to that other state. So then your client's not just paying the Florida tax, but is paying the tax to that other state on the acquisition. And then that becomes basically double taxation. And you might try to argue to that other state, hey, we paid tax to Florida. You should give us a credit for what we paid to Florida. The other state's going to say, no, that other state has the right, the first in time, first in right, to claim that tax is owed, and that Florida should give credit for the tax that's paid. And when I was at the Florida Department of Revenue, I saw instances where a taxpayer would claim that, hey, I paid tax to this other state first. Florida, you should give me a credit. And Florida had to take the position, no, the transaction occurred here first. You owe tax to Florida, and that other state should give you credit for it. You should get a refund from that other state. Right, wrong, or indifferent, it does happen. And that's why clients have to be very careful with if they buy the aircraft in another state and it's not actually exempt. So once the exposure is determined, then it's really a decision time and it is a decisional point for the client to determine what are they going to do? What do they want to do? Some will choose to ignore the other state, maybe most, and just deal with Florida. Others will want to get the other state handled and then take the chance whether Florida will honor or not the tax paid to the other state, even though it was after the audit was initiated by Florida. And so there's a lot of factors that go into determining this. And so your mileage may vary, or your client's mileage may vary on this. Aircraft leasing. We touched on this briefly earlier on in the presentation, but it's worth diving into a lot more. The general rule is going to be the lease of an aircraft in Florida is subject to sales or use tax. However, that lease could be exempt for any number of reasons. One reason is the sale for resale. I buy an aircraft, I lease it to Joe. Joe then wants to lease it to Jerry. Joe can then present me a resale certificate so he doesn't have to pay sales tax on his lease. And rather, he'll collect sales tax from Jerry on his lease of the aircraft. Unless Jerry provides a resale certificate because maybe he's renting it to Paul. And the list goes on and on. But if there's an exemption, then it should not be taxable. You just have to make sure you can prove and you document in your records or your client's records the proof of the exemption, because if not, that could be a huge tax bill that is being left holding by your client. If the aircraft is solely leased in another state and is solely in that other state, maybe it's in California or New York or Canada. I hear lately Canada, certain parts of it are going to become another state. So no longer we won't be talking about the country, but the state of certain provinces there. But if it's in another country altogether, then arguably the calculation is easy to determine what Florida should be owed. And that should be a big old zero. Florida should not be entitled to a single penny of sales tax revenue for a lease of an aircraft that never comes to Florida. Seems pretty straightforward, but let's get this a little bit farther down the unbeaten path here of what Florida does. So what if you have an aircraft that flies 1,000 miles a month and only 100 miles or 10% of those miles are in and over Florida? What then? Well, that 10% of mileage, the Florida Department of Revenue would say, as I mentioned earlier, that that makes the whole kit and caboodle subject to sales tax, and therefore the lease is 100% subject to Florida sales tax. I'd say, wait a second, Florida Department of Revenue, that can't be right. This aircraft is outside of Florida 90% of the time. What if every other state did a similar tax? And the Florida Department of Revenue just doesn't care. They think that they are entitled to 100% of the revenue. Now, there's case law out there about other types of equipment and whether the equipment's subject to tax in Florida, which the Florida Supreme Court said, yes, it is, but only to the extent of its presence in Florida. And so that begs the question, why is the Florida Department of Revenue ignoring case law on this? Why do they ignore any law on anything? And it's because they're from the government and they're here to help. And they help by helping themselves to the pocketbooks of our clients as much as they can by making these assessments that have no basis in law and truly overstating it instead of getting to the right amount, getting to the amount that they feel they owe or think that they owe. But even more so, the taxing statute is one in which it says that the transaction occurs in Florida. The way that it reads is anyone who's engaged in the business of selling tangible personal property for consideration in this state is exercising a taxable privilege and therefore has to collect tax. The key words from that phrase being in this state. So really, we're not talking about an exemption here from sales tax. We're talking about the ability of Florida to impose a tax anyways. And that distinction puts the burden of proof on the Florida Department of Revenue to prove that the transaction is subject to tax, which how can they prove that a lease that is used outside the state is subject to sales tax? I haven't been able to wrap my head around that one, and they have not been able to explain it. But their premise, their guise, their play on this is that this isn't a taxing issue, it's an exemption issue. And David, your client has to prove that the transaction is exempt from tax. Oh, and by the way, the 212.0598 statute that says basically air carriers are exempt, your client doesn't qualify for that among many different reasons. And so because there's no exemption, David, your client unfortunately owes the full amount of the tax. And here's where they can make the payment. We accept cash. If we take credit card, we'll charge a fee, so forth and so on. And the sheer ridiculousness that they pose with this of transforming this from a taxing burden to one of an exemption shows truly the misunderstanding on their part as to the proper application of the statute and how it should run. But don't worry, we're going to get some great guidance for them here in the near future with some case law that we're going to get for them on this. But you should be able to apportion, and your clients should be able to apportion too. And I think a very reasonable way to apportion is based on mileage. Now, the other ways could arguably be manipulated. I think realistically, they're probably not. For example, if it's based on time or days, things of that nature. But if you do it on mileage, that is a pretty straightforward manner in which one can do this. Mileage apportionment could just mean, hey, the time that the aircraft is doing mileage over Florida, if you will, and generating lease revenue, that's going to be your numerator, your Florida mileage, divided by your total mileage worldwide in which lease revenue is generated. And so, for example, if lease revenue is being generated in Florida and the aircraft's just parked in Florida, arguably 100% of the tax is owed to Florida on that. But likewise, if it's parked in Georgia, earning lease revenue, and that's all that it does, just sits there, then arguably nothing should be owed to Florida. It's that in between of, okay, we've got some Florida mileage, but we also have a ton of mileage outside of the state. And that's where the divergence is between the Florida Department of Revenue and those that are being reasonable on the issue. Just because your client is not registered for sales and use tax purposes doesn't mean that they can't still do a sale for resale. A business has the opportunity to do a late retroactive registration. It's a very precise process that if you've never done it before, you can't just go in there and do it. Just filling out a registration is not how it's going to happen. There's a very specific way in which this has to be done. But the benefits of it are one can retroactively register on paper as if he or she or the company have been registered from the time the aircraft was acquired, such that then it makes the acquisition exempt from tax. Because remember, if you're not registered for sales and use tax purposes as a dealer with the Florida Department of Revenue at or before the time of the transaction is subject to tax. And so this retroactive registration allows that fictitious retroactivity of the registration to before the time of the sale. Now, clients will not get out 100% scot-free. So in lieu of paying the tax, penalties, and interest on the aircraft acquisition, they're going to have to pay a penalty. And the penalty depends on who contacts who first. So if the business or the aircraft owner contacts the Florida Department of Revenue first, says, hey, I screwed up. I should have been registered. I wasn't. Please help me get this fixed. In that scenario, then the owner owes the lesser of 10% of the tax that's owed, or $1,000. Now, if an audit's been initiated and the Department of Revenue contacts the aircraft owner first, well, then those mandatory penalties jump up. And they jump up to the lesser of 20% of the tax that's owed, or $5,000. So if you've got $1 million aircraft, that's 60 grand of tax that's owed. 20% in that scenario is going to be 12,000. So the lesser of 12 or 5,000 is clearly 5,000. So your client's going to be saving $55,000 plus dollars. And that's just comparing to the tax. If you add in 50% penalties, so another 30 grand, plus interest, which is 12% per year, it easily exceeds $100,000. So you can really look like a rock star to your clients by using this provision to save, in that example, $100,000 very easily for the client, if you know what you're doing and if you do it right. Because you only have one shot at doing this. And if you do it wrong, arguably, you don't then have the ability to do it again. It may be possible with some finessing, but really you only have one opportunity to not miss your chance. But this is very state specific. So if we're looking outside of Florida just for a moment here on this, I can't say I've recalled this provision, this retroactive registration, in any other state other than Florida. And I think it's because the Florida legislature was really trying to be reasonable of saying, hey, there are so many businesses that are out there that just don't know what they're doing and they think that they're doing things right, but they messed up. Everything would have been exempt if they just filed that application. So we'll let them come in the door for a small penalty. Just kind of make sure they have some skin in the game and not just, oh, whoops, I forgot to do it and there's no consequence to it. I think that there has to be a consequence to hold people accountable for this. So next, we're going to discuss about aircraft repairs and maintenance. Now, many states will have an exemption for aircraft repairs and maintenance. Florida is one of them. The states, they will vary, though, in terms of how they enacted that exemption. Some will just say, no matter what, aircraft repairs are always exempt. Or maybe aircraft repairs are exempt if on this type of aircraft. Or aircraft repairs are exempt if on aircraft of a certain weight. The list goes on and on. But the gist is, know that there are instances in which repairs and maintenance of aircraft are going to be exempt from sales and use tax. In Florida, the rule is going to be, there's two rules. One has to do with maximum certified takeoff weight. So when an aircraft has a maximum certified takeoff weight of greater than 2,000 pounds, then the repairs and maintenance on that aircraft are not going to be subject to Florida sales or use tax. And that can be a huge savings for individuals. There's also another exemption that has to do with repairs and maintenance under a supplemental type certificate issued by the FAA. In that instance, those types of repairs or maintenance shouldn't be, they should be exempt as well. And of course, you have your standard exemptions, such as if I have an aircraft in inventory because I'm going to sell it or lease it and it needs repairs or maintenance, that should be exempt regardless of what I mentioned a moment ago with weight or things of that nature, just by extending a resale certificate. Now, what if you are a non-resident owner of an aircraft and you bring your aircraft to Florida to have repairs done? Remember, I said earlier that just bringing your aircraft to Florida could subject it to Florida use tax just by that very nature, and is why we would go through the analysis of whether you pay tax in another state or whether an exemption applies. There's an exemption in Florida if you are a non-resident of Florida and you bring your aircraft to Florida solely for repairs or maintenance. Now, the repair facility has to have the 3 C's, as I call it: care, custody, and control for that repair to stay, for the aircraft rather, to not be subject to tax, to rather stay exempt from tax during its stay in Florida for those repairs. If that happens, then once the repairs are done, then the clock starts ticking on the aircraft owner to get the aircraft out of Florida before tax ultimately becomes imposed on the aircraft for just sitting in Florida for a certain amount of time after the aircraft's done. But this begs the question of who is a non-resident? If we're talking about an individual, we'll look at driver's license, voter's registration, homestead, and other similar aspects of determining whether that person is a Florida resident. So, for example, I have a homestead in Florida, I vote in Florida, and I have a Florida driver's license. I'm a Florida resident, and therefore I wouldn't qualify for this exemption. But what if I form a Delaware or a Montana LLC? And of note, those states don't have a sales tax. There's 5 states that don't have a sales tax. So we see a lot of individuals form those entities just thinking, well, it's a Montana LLC and I can go anywhere and not pay tax. That's not true. But if I form a Montana LLC and the Montana LLC owns the aircraft, and then I bring that aircraft to Florida. So I own the Montana LLC and the Montana LLC owns the aircraft, and that aircraft comes to Florida. Arguably, I should get non-residential treatment because I don't own the aircraft. The Montana LLC owns the aircraft, and the Montana LLC is not a Florida limited liability company. And so there's authority out there that suggests that one stops its non-resident analysis at the entity level. You don't look through to the owners to determine their residency. However, as is everything else that I see, certain areas of the Department of Revenue will look through past the entity to the individuals to determine the residency of the individuals and say, all right, well, David, you own this LLC, even though it's a Montana LLC and we agree with you that it's not a Florida LLC, we're going to say that this is residential treatment and therefore you owe tax on the aircraft as soon as it touches down in Florida. I disagree with that, especially for the reasons I stated earlier. So the non-residential aspect should apply to the owner, not the owner of the owner. Because if that's the case, and if I own Procter and Gamble, Nike, whatever, and they bring aircraft to Florida, well, I'm a Florida resident. I own shares of Nike or Procter and Gamble, so automatically the aircraft's subject to tax in Florida. To me, that just doesn't make sense, and is why I think the department's position on that just utterly fails ultimately when you apply common sense to the situation. So we talked about apportionment, but let's dive into this a bit more here. Uh, I think first and foremost, one has to determine when apportionment applies. And in order to do that, just me buying an aircraft, bringing it to Florida, and I keep it in here for 6 months and then I bring it outside for 10 years, I don't think that I can say that, all right, well, only 5% of the activities were in Florida, so I only owe 5% of the tax. I don't think it works that way. Apportionment should come in when, at least in the realm of aircraft, when the aircraft's being, for example, leased. And based on mileage, engine hours, flight hours, or a flat daily rate, you can apportion it from there. Now, what I would also say is that the mileage has more statutory authority behind it because there's other provisions for motor vehicles and vessels, to name a few, uh, that they use apportionment based on mileage. So using mileage apportionment for aircraft seems exceptionally reasonable. It can just be a challenge to do because there's the administrative compliance cost of tracking the flights, converting to mileage, and then filing the sales tax returns for that. And that's why some people just decide, look, I'm not going to bother with all this apportionment stuff. I'll just pay the tax and be done. And I don't blame them. I think it is just a reasonable position to take in terms of the cost benefit of things. And that's why I can appreciate that. But for those where it does make sense to apportion, using mileage, that's objectively verifiable. You can see, all right, I flew from Tallahassee, Florida to Atlanta, Georgia. Here's the flight path. This is the amount of mileage it is. This is where the Florida-Georgia border is. So I can see, yes, it is 25 miles from the Tallahassee, Florida airport to the Georgia, to cross into Georgia. Therefore, the whole trip being 200 miles, and I was only in Florida for 25 of those miles, I owe tax on 12.5% of the revenue. I hope my math is right on that. Having a call full of CPAs, I'm sure you guys will double check me on that. But you can also do arguably on engine or flight hours. So same trip takes me 2 hours and I'm in Florida for half an hour of that time. Well, then maybe I do 25% of my hours. But maybe I just pay $100 a day for lease revenue and the aircraft's in Florida for 10 out of 30 days in a month. Arguably, in that instance, then I only owe tax on 10 out of the 30 days or $1,000, if you will, for $100 a day. And so that's how I would argue that those three different could be applied. It's going to depend, and it's going to depend from client to client on what works best for them. And it's also going to depend on what types of records they'll be able to keep. So maybe the flat daily rate works for them because they have no clue how to do mileage. But whereas the next client, maybe they have software that can calculate the mileage pretty easily just based on origin and destination airport codes and spits out what the Florida mileage is, what the total mileage is for the trip, and can get you the apportionment just like that. The state's boundaries, of course, if you're driving on I-10 west, you go through Tallahassee, you get to Pensacola, and then you eventually get to Alabama. And there's a nice sign that says, you're leaving the free state of Florida, please come back quickly. And then the next sign after that is welcome to Alabama. So it's pretty clear where Florida and Alabama ends when you're driving. I call it the x-axis. But how high up does Florida go? And arguably, I think that Florida ends at just a couple hundred feet. So if you're doing this mileage or engine flight hours, there's the ability to apportion a de minimis amount to Florida because you're no longer in Florida airspace. And the analogy I would draw would have to do with the ocean. So for Florida, the Florida boundaries are defined constitutionally on the Atlantic side to go 1 league out, or to the Gulf Stream. Let's just call it the 1 league though, because the Gulf Stream actually changes, believe it or not. So 1 league out is just over 3 miles. Call it 3.25 miles. So if I do a transaction 5 miles out off the Florida coast in the Atlantic Ocean, I'm not in Florida anymore, and I shouldn't owe any Florida tax on any of those transactions. I'm still in US territorial waters, but not in Florida. And the theory is instead of that being on the x axis on the sea plane, if you will. We're shifting that up into the sky, basically based on altitude. And is why I don't believe Florida can tax certain transactions occurring above a certain threshold, a certain altitude, if you will. So it's very clear where the state's boundaries are. And I think that this is a winning argument because, again, it's a taxing statute. Whether Florida has the ability to tax a transaction occurring at 30,000 feet, is that even in Florida? And I think arguably it's not. And that's why I think it works. Now, Wayfair, for those of you familiar with it, has to do with a state's ability to tax transactions for companies that are not within the state. And so what happened was states were losing revenue. They wanted to find a way to get that revenue back from all those online sales that sellers weren't charging sales tax. So they came up with economic nexus, just basically saying, look, if you sell a certain amount of property into our state, then you have nexus, a requirement to file sales tax in the state. And therefore, you must collect sales tax on your transaction. So if you are selling an engine, landing gear, tires, you name it, into certain states, you might or your client might have a sales tax filing requirement in that state. That's even if 100% of the transactions are exempt. Because they can be exempt, but that does not absolve the client of the requirement to file a sales tax return in the given state. Now, it gets even worse if what they're doing in the state is taxable. There's no exemption for repairs, maintenance, or parts for aircraft. Then they're going to have a bigger problem because then they have an exposure in those states. And so then they're going to have to really think about how to get this cleaned up. And in terms of that, they're going to have to do that quickly because the longer it stays outstanding, the deeper of a hole they're going to dig themselves into until it becomes a bankrupting liability. Moreover, buyers are doing due diligence on the sales tax side. Ever since Wayfair occurred 7 years ago now at this point, uh, buyers have been asking about the state and local tax implications because they are huge implications to transactions that can sometimes cause a deal to be killed. We talked about the flyaway exemption previously and the qualifications for that. There are no occasional or isolated sales of aircraft in Florida. That's specifically stated to not occur. And so the relevancy of that is usually the occasional or isolated sale rule says, hey, if you only do up to 2 transactions of something that's taxable in a rolling 12-month period, then you don't have to collect sales tax. But that third one, you do have to start collecting sales tax. But that provision doesn't apply to aircraft, at least not in Florida, but it can in other states. And that's something to keep an eye out for. Now, registering for sales tax in these other states could cause you to have to be, or your clients to be registered for other tax types in other states. Maybe for income tax, maybe for a stock tax or a franchise tax or something. But I can tell you this, the states, they have tons of different taxes. It's impossible to register for all of them. But registering and getting the big ones cleaned up, the sales tax or the income tax as appropriate, can really make the difference between night and day. Their exposure without registering, though, can be huge. So technically, the statute of limitations only runs when a company is filing sales tax returns or filing the tax return in general in the state. And so with that in mind, if the tax return hasn't been filed, then the statute of limitations hasn't run, and therefore the company's liability stays open indefinitely. And so the state could go back to the beginning of time when they first incurred a liability. That might be 1 year, might be 10. And the longer it is, the greater arguably the liability is going to be. There are a ton of different tax-free transactions or potential tax-free transactions in Florida. Seeing that we're running out of time, I'm just going to fly through this. But it's going to depend on the state law. So just discussing Florida briefly, it could be a gift. I gift Ethan an aircraft, a Gulfstream aircraft, so $6 million aircraft. That could be exempt from Florida sales or use tax. It could also be from partnership to a partner or a dissolved corporation to a stockholder. When that happens, that can work. Consolidation mergers, that works as well, but it has to be pursuant to certain Internal Revenue Code provisions. Distribution to heirs, it seems like it would be a little dirty to tax someone just because they inherited something for sales and use tax purposes. So there's a specific provision for that. And then husband and wife that are transferring assets because they were formerly married, so now they're divorced, and perhaps it's pursuant to a court order or some agreement between the parties, that should be tax-free as well, exempt, I should say, from sales or use tax. Civil penalties. It's huge and it makes an appearance in every single presentation I do. And so Florida has the ability to impose a personal penalty on each individual. And it's not just each individual, but it is beyond the people that own the company, the owners, the officers, the directors, or the responsible persons in certain circumstances. So the company's liability could go to the individuals and be doubled at that point. But true story is a few years ago, the Florida Department of Revenue said, look, we're not only going to go after, if your client, the business, doesn't pay this liability, we're not only going to go after each individual, but we're going to go after their CPA as well, personally. You better believe that that client then paid up their liability pretty fast because the CPA wasn't happy on that. And I think that it was wrong for the Florida Department of Revenue to threaten that type of an action against the CPA because the CPA is only preparing the returns based off the information that they received from the owners and officers. In no way, shape, or form are they responsible as the owner would be. So I thought that that was a pretty poor tasting move on the Department of Revenue's part. Sales tax is going to be a trust fund tax, which means if it's collected and not remitted, you can go to jail. And it takes just $300 in Florida for that amount of sales tax collected, not remitted, to be a third-degree felony. And that's per filing period. So if you have a 3-year filing period and 20 of those months have a third-degree felony because it had $400 of sales tax, yeah, it's only $8 grand of sales tax. But is it really justifiable to go to prison for up to 100 years? Because that's what it is for a third-degree felony. It's 5 years in prison and or a penalty, a monetary penalty. Second-degree felonies go up from there, and then first-degree felonies are up from there, up to 30 years in prison. And they can combine it to make it a bigger felony to go from third to second or second to first, if they so choose. So it doesn't take much to be on the wrong side of the law with that. Florida and other states have so many different weapons to stack the deck against businesses. So often do they use the guilty until proven innocent tactic, whether it's that the individual failed to provide, quote, sufficient information and documentation. When the state can't even define what that is. They just use their feelings to feel like, yeah, this doesn't feel like it's sufficient, so I'm going to say they owe the full amount and go from there. We talked about civil penalties briefly. The state can also revoke the sales tax permit, which effectively shuts down the business if that happens. It can deny new registrations if the owners or same people are involved with a new business. They can do that. I think that's wrong, and I think that there are ways to fight it, and you can fight it, in fact. Transferring liability. If you try to transfer the assets, the majority of the assets, to avoid liability, so think an asset sale, sales tax can still follow it and does in fact follow it. And then of course the criminal implications as well for this. There are tons of different places that you can go to find the Florida law on this, you can go to our website, which is at the top there, floridasalestax.com. Or if you're having a particularly tough time falling asleep, you can go to all those other websites that have the statutes or the rules on them to take a look at that. You can also contact the Florida Department of Revenue or any other state. And here's a pretty much true story from when I was at the Florida Department of Revenue. And so being the subject matter expert of various issues, including for aircraft sales and use tax purposes, I got a lot of very focused calls on certain areas. And sometimes people would call me and say, look, David, I talked to 3 people, got 7 different answers. What is the answer here? And the answer is it depends. Getting the answer from the Florida Department of Revenue is not necessarily right. I can't tell you how many people have hired us and how many clients we've been referred to that their CPA or their attorney called and relied on the agency for a determination, only to then have the auditor pull the carpet out from underneath their client and say, no, that was wrong. You should have been doing it this way. Here's your huge bill. We get hired on that all the time. So don't fall victim to that trap. It's easy to call and just see what it is, but there's other ways around that, such as with letter rulings from the Department of Revenue or any state for that matter. Getting a letter ruling is very simple. You just have to know the process. If you just go through the generic steps, then it's not going to get you the binding letter ruling that your clients will likely need and be able to rely on like they can on an insurance policy. And so I would recommend that. I also recommend voluntary disclosures. If you or your client determine that something's wrong and it needs to be fixed, voluntary disclosures are a huge thing. The thing is, the client has to contact the state first for the voluntary disclosure. If the state contacts the client first, even if the client hasn't received the communication, think a letter in the mail, the client's disqualified from the voluntary disclosure right off the bat. And then you're defending against an audit. But voluntary disclosures usually have reduced penalties, a reduced look back period, and can also help to mitigate the chance for an audit. If you have any questions, you're absolutely more than welcome to contact me anytime. My contact information is on the screen here. My telephone number, that's my direct line. I'm more than happy to take cold calls anytime. I also respond to emails very quickly as well. And if you want to follow me on YouTube for more videos, my YouTube handle is there. I'm the Sales Tax Lawyer on YouTube. So you're more than welcome to like, subscribe, and get notified for whenever I post videos, which is usually about twice a week, give or take. Y'all have been a great audience. Thank you so much for attending today's presentation, and feel free to reach out if I can answer any questions. Take care.